again, everybody, and welcome. Tom Daly here from the Academy of Financial Trading. We are about to begin your very first lesson in what we are fully sure will be a thoroughly enjoyable series, which we call the Foundation Trading Program. We're going to be going through many of the core principles regarding financial trading. We're going to be showing you how the financial markets work and what other participants do in those markets, and then how we can find opportunities as a result of that. So to begin with, in this lesson, like with all further lessons, we will start out by having a look at our risk warning. It's crucial that we're all aware of the risks associated with trading, with leverage trading, and with investing as well. In all areas, it is the acceptance of that risk which can generate profits and returns for individuals. Before we get into the thick of this evening's class, just a very brief snapshot of the Academy of Financial Trading, who we are and where we have come from. We did indeed start out as a company called the Academy of Financial Trading, providing education to those who wanted to learn about the financial markets, how they work, and what you need to do in order to be able to trade them successfully. Since then, we have branched out into many other further fields of study. We have formed, an umbrella group which allows people to access a huge range of other subjects. It was indeed founded in 2012. At this stage, we are the largest live educators on the planet, and that indeed is what sets us apart from anybody who might consider themselves to be competitors of ours. We educate over 50,000 people every single month, all on a live basis, just like this webinar which you are now on. We have offices across 3 different continents, and we have at this stage well over 200 full-time staff. We also have that diverse range of subjects across 10 different languages, so as to cater for as many people as is possible. So hopefully what this is showing you is that we are well versed in the educational entity. We are well versed in how to indeed perform best as far as showing you what you need to know in order to progress with this given subject. So a warm welcome to you all from everybody here at the Show Academy, everybody here at the Academy of Financial Trading. It's important to start out with the truth about financial trading. With this webinar, what we want to do is we really want to set the context, and over the next few moments we're going to be going through many of the questions which I can see a lot of you typing in already, and we'll be making sure that everybody is fully comfortable. So the likes of housekeeping questions about microphones, about questions themselves, about accessing recordings, all of these types of areas we will be covering in the next few moments. But before we actually do that, we must start out with the truth about financial trading. So when it comes to financial trading, achieving success and achieving results, it can indeed occur. And in terms of those results, they can be very, very positive. But in order to have those levels of successes, we must work hard at what we do. And from our perspective at the Academy of Financial Trading, we take maybe a bit of a different trajectory in terms of our teaching. We do view ourselves as a fully academic-based teaching institution, in that what we are focused upon is to help you to achieve consistent and conservative growth. What we mean by that is from time to time, people will actually come to us and they might be looking to make 400 or 500% of a return per month. We're not going to tell you that that is possible, because that would be absolutely crazy for us to say. So we're not going to make false promises. We are going to build a full foundation level of knowledge. We're going to encourage you to attend these live events and to ask as many questions as you can, and make this a truly educational experience. Because you probably know, but we definitely know, that trading can be extremely rewarding. So how we intend on teaching is very, very important. We will start out with a particular subject matter and we will define it and we will explain what it is from an overview perspective. Then we will teach you through interaction, through asking you questions, through stimulating your brain to learn and to grasp this subject matter. All of this, breaking it down into bite-sized chapters, will lead you to appreciate how the financial markets conceptually work. Okay, and how we can then find our opportunities in those markets. That's exactly what we're going to be looking at. Over and above that, we will be helping you to achieve your trading edge. And your trading edge, it means, I guess, the advantage which you have got in the marketplace, which is crucially important, massively important. It gives you a justification. So why are we all here? We're all here to begin to understand how these markets work. What I have on the screen in front of us now is an oil chart, and what we will be looking at over the coming days and weeks is how to, if you like, read this chart, how to understand what exactly this chart is telling us from an information perspective. We can look at this chart, which is, as I've said, oil, and we can see that in 2008 it was trading as high. It went up over $140 per barrel. It touched off $150 per barrel, and it moved all the way down to roughly where it is now. I know this is a snapshot back from August, but still it's telling us that it was down around that $37, $38 per barrel. Not only that, this is not just a random nature or random sequence of events. If we just look at that middle portion of the chart where I've drawn one little black line and then another one on top of that, we can see time and time again the price perfectly interacting with these lines. And what we will be looking at is how we can take advantage of these interactions. This is the exact same way in which the financial markets have been analyzed since time has began. So this is what we're going to be leading up into. And once we get this foundation level from tonight and possibly even in lesson number 2 in 2 days' time out of the way, from next week onwards, we will be looking at these charts in much greater detail, how to read them, how to draw these lines, how to be aware of potential signals, and then how to take advantage of the actual price movements as they occur. So that is what we have to look forward to, more particularly from next week onwards. What we want to do tonight, we will spend the first maybe 5 minutes or so from here just going through the agenda, talking about the market recordings, or excuse me, the lesson recordings, how to access them, a little bit of housekeeping before we get into the definitions of markets and how they all work. So let's go through this agenda. Let's go through this running order for our teaching. Your first week, it does lay the foundations of your foundation trading program. For those who have experience, some of the first week it might be a little repetitious, but we must maybe play it safe in terms of ensuring that we're all on the same page. So this evening we will get stuck into what moves price in markets. Then in 2 days' time we're going to look at the mechanics of trading. How does one physically place a trade? Your second week is where things really get exciting. We go on to these charts. We start looking at technical analysis. We look at ways of analyzing markets, how to take advantage of the movements. The third week kicks off even more important movements, how to find opportunities. Your 8th lesson and onwards from there are going to be extremely important for a variety of reasons. The 8th lesson because it talks about you becoming a counter retail trader. What that is trading like the most successful institutions which exist. Your final week, we call it the risk management week. In my opinion, the most important week, not only because it will scare away all of those people who were looking for that 500 or 600% of a return per month, but more importantly because it focuses upon protecting that which you have worked hard for, and then for protecting profits in the market as well. So what are the objectives? Our objectives essentially are to show you that every single professional must start from somewhere. People oftentimes, they come to learn from us, and they might have seen advertisements from people who might call themselves competitors of ours in the educational space. What happens is that people expect that by the end of this webinar, they can give in their notice, they can order their Ferrari. That's not our style. That's not how we operate. We're not going to talk that type of nonsense. We're going to say to you that if you decided to be any professional, a trader, a doctor, anything else, you must start out with the basics. A medical student will start out by understanding how the human body conceptually works. And from there, you might begin to understand how to cure a particular ailment. If they didn't know that us as humans has a heart or lungs or any other organs, it would be pretty difficult in terms of helping patients. If you as a trader didn't know what drove the price, that would be crazy. So we're going to look at things from our own unique perspective. What is our perspective? I suppose in terms of what we believe, our own background is within the hedge fund community, after that within the brokerage community, in terms of specific market makers. So our perspective is trying to teach you to trade like a market maker. And why we want to do that is because they make a lot of return. So what better group to learn how to trade like? So it's all about consistent and conservative long-term growth. And a lot of people have been asking, a lot of people have been typing in, what have we got? A lot of people asking along the lines of how to ask a question. How do we engage? How do we type in questions? Is it possible to receive the slides? Let's talk about these. You've got a control panel on your screen. The orange arrow increases or decreases the size of this area. Within this area, if you've got a question, type it in and we'll do our best to answer it. The key point here is that if your question specifically relates to where we're at, we'll do our best to answer it orally there and then in person in spoken form. If not, or if it might interfere with our own train of thought or another's, we'll give you a typed answer back. So Peggy, you have it absolutely right. So we are supported by very, very experienced individuals who know exactly what we are covering in great detail, and they'll be able to answer you in real time. They'll be able to help you to remain on track. At the end of every single webinar, we will remain at your disposal in order to go through all of the remaining questions in real time. In real time as it stands. The biggest question which has come in so far, as always tends to be, relates to how do you access this lesson after the fact? Or what if you miss a lesson? Or what if you're going on vacation? Or anything of that nature. So in terms of the recordings, we give out the recordings as opposed to the PowerPoints, but we will be looking to actually make the PowerPoints available. Hopefully by the end of the next lesson, we'll be able to come up with something that will be able to provide you yourselves with access to the PowerPoints so you can refer back to them at your own convenience. In terms of accessing the specific recordings, let me just show you exactly how that is done. So you see our homepage, it's www.academyft.com. And whether you've come through us directly as the Academy of Financial Trading, or indeed whether you've come to us through Show Academy, you must go on to www.academyft.com in order to access the recordings of this foundation trading program. So maybe that's the first thing to realize. When you go on to www.academyft.com, you click on that sign in button on the top right hand side. It brings you through to a new page. You pop in your username and your password. Your username would typically be the email which you initially signed up to this course with. The password you would have chosen yourself. If you have forgotten your password, don't worry about it. Still fill in your username, and then what you can do is just click on that Forgot Your Password tab. When you do that, you'll get an email almost instantaneously, which will remind you of said password. When you go into the members login area, you will see that not only will you have a nice greeting, you're also able to attend the actual live webinars for there. So every time that a live webinar is due to begin, just go into members login, click on start live webinar. It should bring you straight to the page itself. You also see right along the bottom that you have an introductory video up there already, which is just over 5 minutes in length. From tomorrow onwards, these will get populated. Lesson 1 will be available we normally say within 14, 15, 16 hours of this evening's class come to an end. So in about 15, 16 hours there or thereabouts, lesson 1 will be available. It'll be after we produce this a little bit, take out any coughs or sneezes or splutters that I tend to make throughout these classes, and you'll then be able to access the recordings. These recordings will be available for 1 week after the entire course comes to an end. So it'll give you ample opportunity to go back and review and take notes at your leisure. So hopefully that is understandable to absolutely everybody. So what we also have to help maintain your interest throughout this foundation trading program is we will be running a competition. What we like to do is we like to reward the students who attend live, because we do feel that they are the ones who benefit the most. Passive education traditionally has not worked because, you've got your family commitments, you've got your professional commitments, you've got your life and everything else, which gets in the way of you learning new things. We understand that. So what we try to do is we try to make it as enjoyable and maybe even as theatrical as possible so you can really grasp what we're covering. We also will reward your attendance, because if you attend these webinars, you're more likely to benefit, you're more likely to tell your friends, which is much better for our business. So what we will do this month, we only launched it very recently to huge success, is we are giving away a scholarship prize to the Show Education Group, and that will mean that it'll get lifetime access to every single program within Show Academy. Now, there is a caveat to that. The winner from that draw will be drawn from those who have attended greater than 50% of the lessons in live instances. So if you're enjoying your lessons and if you are attending, you will be entered into that prize draw to win. And the good thing is that there aren't a huge amount of people who are attending. So I guess that means your chances of winning are quite large. Okay, so that's just a nice little value add that we're trying to do so we can all have a little bit of fun while we are learning through these lessons. The very final part which you want to go through before we get stuck into this evening's lessons is we are indeed on social media like most companies tend to be these days. You will find us on Facebook, you'll find us on Twitter, you'll find us on Google+, where we will be discussing these topical items which pop up frequently, whether it is, again, the large moves on the stock market in China and then the subsequent weakness in the markets throughout the Western Hemisphere. But we do find it to be a very convenient way of communicating, and hopefully in your chat box now, the support team should be typing in these specific links which you can access at any time in order to avail of these additional services which we will make available for you, to you, absolutely for free. So that's a nice little value add. So now we have all of the housekeeping out of the way and we're able to get into the meat of this evening's class. Let's start with these financial markets, why we are all here and what we are actually looking to achieve. So the financial markets explained. Hopefully, we're all here to try to generate a secondary income. Hopefully that's in terms of looking for profits in the financial markets. What we believe our job is, we believe that our job is quite straightforward. I suppose it's quite straightforward because every single person here, you have actually traded before. You've traded in some way, shape or form. Because what a financial market actually is just like any other marketplace. It's just like a fruit market or a local food market. When you go to a local food market, guys, let's try to go through some role-playing scenarios here. And let's talk about this and let's try to figure out all of our perspectives. If you went to a food market and if somebody had, Nicholas, if somebody had a bunch of strawberries for sale for $1,000, what would you think? What would you think? You went to a food market, Nicholas, you had a hard week in work, and next thing you see some strawberries. And you can see that they are $1,000 in price. They're not made of gold. They don't make you live forever. They don't cure grey hairs. They don't do anything of that nature. What do we think of that? Well, a lot of people are typing in that it's crazy, that it's too expensive. A lot of people are typing in quite aggressive things. Absolutely. Natalie, you're saying it's ridiculous. John, that's a bit of an Irish slang term. I'm not sure many other people would get it. But yeah, it is silly to begin with, isn't it? It's a rip-off, Simon. Absolutely. You would go somewhere else, Frank, without a doubt. So we would say that it's way too high. It's too expensive. We're just not interested. But guys, how did you know that? How did you know it was too expensive? Can we step back for a second? How did you know to think that the price was too high? What made you make that decision? How did you do it? Well, you did it because you know the price of strawberries. You know how much you paid yesterday or last week or last month or any time period in the past. You see, you remember the price which you previously conducted a trade at. And you know what we do as traders? We do the exact same thing. We make comparisons. Then we look at, well, how much does it cost to get those strawberries there? How much should an individual make in that type of scenario? We use logic, Paula, absolutely. We use deduction. We use supply and demand. Just like every other single day when we buy or sell things. Our job is to just show you that connection. So when we talk about the financial markets and when we look at them a little bit further, we say that all objects are similar because of one constant. And that constant is you and I. We are human. And because of that, our human emotions come through when we agree as to price. Because price on a screen is just a consensus of value. It's the price that a buyer and a seller have just agreed upon. So what we do is we view these charts, whether they're for oil, like we already looked at, whether they're for gold, whether they are for currencies, whether they're for any other commodity, whether they're for the Dow Jones. We just view them as representing agreement. And then we try to figure out what direction it's going in. Is it going up? Is it going down? Or is it going sideways? And then we just ask ourselves, how confident are we? You have traded before. So what are the purposes of the financial markets? Let's all try to interact. Let's all talk through the medium of typing in the answers. What are the purposes of the financial markets? Why do they exist? What are they for? Type in your answers, guys. Oh, and you're saying to make money. Darren, you're saying to sell stocks. What else have we got? Elena, you're saying liquidity. David, also to make money. Other people are saying to invest. Stephen, you're saying to raise capital. A lot of people saying to make money. For analysis. Okay. Capital for a company, says James. All of these answers are fantastic. Let's talk about which ones are most relevant and why. We speak about raising capital. People come to us and they ask if trading the financial markets, if it's morally or ethically correct. Our answer is that, to be honest, we don't wish to give a spiritual decree in that sort of line. It's not what we're qualified to do. But what we do say is when it comes to raising capital, there are legitimate purposes behind the financial markets. So let's step back and think about this a little bit, okay? Let's step back, Ollie, and let's imagine that you own a pharmaceutical company. And that pharmaceutical company is on the verge of creating a magnificent piece of medicine which would develop mankind, which would reduce the damaging effects of some horrible ailment. But you don't have the money to proceed. Does your idea just go back on the shelf? Does your ability to help one another just disappear, Ollie? Or should you? Or could you go out and seek investment? Could you find people to invest money? And that might then go public. And what happens is if people raise capital, then what they do is those people who would have invested, well, then shouldn't there be a return if it works out well? So that's what happens. That's what stock markets are designed to do, to raise capital, to innovate, to allow people who have an entrepreneurial flair to actually continue to operate. And yes, they'll generate wealth, but they'll also generate a huge amount of employment and further society in the process. That's one of the major reasons why trading in the financial markets exist. And then we speak about the transfer of risk. We're going to use this word risk quite a lot because everybody else out there avoids it because they're afraid of it. They're afraid that they're going to scare you away by using it. They think if they don't talk about Ferraris and Lamborghinis and private beaches that you're just going to go away and not do business with them. But we're happy if people like that disappear because we talk about risk. When we speak about risk, we view it as something that is good because that's where we get our returns from. So when we speak about the transfer of risk, let's do another bit of a role play. Let's imagine this. Let's imagine that all of us, collectively, all of us brilliant people on this webinar, we decide, you know what, we don't want to do what we do as our 9 to 5 anymore. We don't want to stay in the rat race. We decide in this situation that we now want to go out and become an agricultural farmer. We decide that we always have had this need to go back to the countryside, okay? So what do? Collectively, we all say, let's go and let's produce corn. Corn, the agricultural crop. What risks do we face, guys? Collectively, what could possibly go wrong for us, the new corn producer? What could possibly go wrong in this magnificent world of ours? Absolutely, you're getting it. You've got weather issues, you've got climate control issues, you've got crops failing, you've got a huge amount of issues which can go against you. But what do? We're corn producers. We go out and we try to make as much as possible. But the weather comes along and it absolutely destroys our crops. So we're pretty annoyed. So what do? Well, we go to the insurance industry and we say that next year I want to insure my crop and I want to ensure that I'm going to produce a certain amount and I'm willing to pay a premium because the effect of me getting it wrong could wipe me out. So the insurance industry develops. So we're fine with this. Ladies and gentlemen, is this all that could go wrong for us as corn producers? Or is there something else which could go horribly wrong? A lot of people are going to get, Thomas, absolutely. We could end up with tons of corn. And what if nobody wants it? What if everybody else has tons of corn? We could have literally tons and tons of corn, but if we can't get a good price for it, then what's the point? Okay? So what we do is we say to ourselves that this is absolutely insane. We want to develop our holding. We want to invest in infrastructure, in roads, in machinery. We want to employ more people, but we can't because we cannot plan our financial affairs. And then we have to ask, then who does actually want to buy our corn? Okay, who wants to actually buy the product? So we sit down with a manufacturer of items which requires corn and we say to them, you know what, we need certainty as to how much you're going to buy my crop from me for. And the manufacturer turns and says, you know what, this would also help me. Because if we both have certainty, we can both plan our financial affairs and we can lock in the future price. And obviously that's once we agree it's of a particular quality and we stick to our agreement. So what develops is what's known as the futures market, commodity exchanges. And what that helps to achieve over the past 150, 200, 300 years is stability in terms of the most important thing which we all need, which is food. And that's what happens. And behind the scenes, risk is being moved around all over the world. What we can do as speculators is we can buy or sell that risk. We can say that we think the price of corn is going to go up because maybe something crazy is happening in Eastern Europe or the Middle East. Or maybe we feel that the weather is so hot or something along those lines. If we have an opinion, we can get involved. We can take some risk. We can make some profit. So the transfer of risk is crucially important when it comes to financial trading. Then what we also have is price discovery. That's a nice easy one. Price discovery means that we negotiate. We go to our market. The guy or lady who asks for $1,000 for strawberries, we politely pick them up and throw them at the shopkeeper one by one. That might be quite an aggressive way to discover the genuine price. Another way might be to ask that individual, what is the real price? Or better put, how much did you sell your last batch of strawberries for? The shopkeeper tells you that, and you then make a counter offer. So we negotiate. Then we have the transfer of liquidity, moving money around the world. If you want to develop a particular manufacturing plant in Europe, if you're coming from the States, you're going to need some euros to develop that. So you move some money. But you see, those who might have traded or those who might have speculated before, you might never have even considered any of these points. You might have just thought all about pure speculators. Did you ever stop to think about international trade? Maybe a price is going to be reached for a particular item and people won't buy it. Maybe they'll buy something else. Maybe they'll say no way, that there are other alternatives. So that's what you've got. You've got international trade, and that makes up a massive amount of every single market. So these areas are certainly in place to help us have a holistic overview. And don't worry guys, at certain times you might miss a particular point, Stephen. When I went to university, it happened all the time. That's why you study after the fact, to make sure you grasp everything. So let's have a look at accessing the financial markets. Online trading, it allows you to speculate on the future price movement. You can trade 24 hours a day from Sunday evening right to Friday evening. You can trade from anywhere once you have an internet connection. Now there is a bit of a comparison to this. Okay, anyone can take a parachute jump out of an airplane. And you could also do that without a parachute, if you so wished. Just because you can do something, it doesn't mean you should, and it certainly doesn't make it any easier. What we are on is a bit of a crusade. And what that crusade is, it's to show you that you must learn before you go rushing into trading. You must have an understanding of what is happening, because otherwise you're competing with people who do have an understanding. And there are things which you need to understand. And what they are essentially is what is tradable, who else is trading, and when and how to trade. And this evening we're going to look at the top two headings in particular. The third heading is not an easy one to cover. We're going to cover it throughout the rest of the course, and hopefully we'll have quite a bit of fun in the meantime. So when we talk about what is tradable, let's have a look at this a little bit. And don't worry, you don't need to make notes. You can go through the recordings, as I've said as well. So we speak about options contracts to begin with. Who here has traded options before? Type in that word option if you've traded options contracts previously. I can see that Nick and Oliver and who else, and Neil and Gassan and Salal. Okay, it's not hugely popular outside of the US. It's quite popular within the US. No problem. Yeah, it's calls and puts. It's options contracts in general. Okay, so what are they? Well, they give you an option to purchase something at a particular price at a particular time. They give you a right to purchase without an obligation. Now, guys, let's just do something to I guess, nail home our feelings on this subject. Do you think the price of gold will be up or down in 6 months' time? Just type in up or down. Do you think the price of gold will be up or down in 6 months' time? What do we think? What do we think? Let me have a look. Let's wait for a few seconds. I'll tell you what the consensus is if I can. Do you think the price of gold will be up or down in 6 months' time? Generally speaking, I think we've got up coming in. I'm going to take a guess as to why that is in terms of what's politically and I guess militaristically happening at the moment. But a lot of people are typing in up. That's fine. Now guys, give me some help on this next question if you don't mind. Could you tell me the price which gold is going to be on, let's say, the 22nd day of April this year, 2016, on the 22nd of April of this year? What's the price of gold going to be, if you don't mind? Just type it in, guys. Okay. Do you appreciate how ridiculous that question was? Do you appreciate that you could say that I was maybe daft for asking that question? What do you think? Can you appreciate that the first scenario was a hell of a lot easier than the second scenario? Calling the direction isn't easy, but calling the exact price in time is incredibly difficult. That's why we don't like options contracts. They're just too tough. Okay? The next type of contract is a futures contract. That we like. You can speculate on upwards or downwards movements. You've got some flexibility in terms of when you enter and exit. The only issue here is that there is some leverage, but not a huge amount. Leverage will be covered in a lot more detail in 2 days' time, but what it relates to is the ability to trade larger amounts. And trust us when we say that it will be covered in 2 days' time. So we kind of like futures. If we look at spread betting, and in particular jurisdictions, it's hugely popular. Okay? In terms of spread betting, that we have some issues with it. The gains are tax-free. Okay? The gains are totally tax-free. Can I ask maybe another question? Okay? Another question. Okay? Think of it like this. Have you ever encountered the revenue officials in your country not to tax an area where people were making lots of money? Have you ever encountered an area where you just thought that the revenue officials are totally asleep, there are lots of people making lots of money, and the revenue have just decided, you know what, we're just going to have a sandwich today. We're going to sit at home, we're going to eat lots of sandwiches, and we're not going to tax anyone. What do we think? Is that plausible at all? What do you think? Or do you think instead they're not taxing the people who make money, because if you tax on profits, you must also offset losses? So if people were to be taxed when they made a profit, every single person who lost could claw back those losses from a capital gains tax perspective from the revenue officials. Guys, the revenue officials in most jurisdictions are not foolish. There are strong reasons as to why betting in many regions is tax-free, and it's because it would kill the exchequer if it was to tax it. This type of speculating, it sees you betting on a financial market. Anybody who thinks otherwise clearly has a word reading the second part of the title, spread betting. That's what it is. It's betting. What's happening is somebody is taking the other side of the trade. They're speculating that you are getting it wrong. They'll tell you that they are lying, or that we are lying, but we are not. Their interests are at odds with yours. Because for them to gain, you must lose. And if they have to see you hurt for them to gain, will they help you? What do you think? Will they help you in any way? If you went into a bookmaker's and, would that bookmaker genuinely try to help you to make money? They just could not do it, could they? It would be an impossibility. It's as simple as that. The next type of option, I guess, that we have is CFDs, contracts for difference. This we're not so bad on. Not so bad on these at all. You can speculate CFDs without actually acquiring. There is leverage. There's a possibility for those returns. There is the option for more diversification. That's what we like. We like diversification. But it is important to remember that you also in this industry you have brokers which are market makers who are working against you. So it's important to look at STP brokers. When you're dealing particularly in the US, it is important to point out that CFDs themselves you're not able to trade in the US. That's absolutely fine because over the course of this foundation trading program we will be catering to exactly to your needs also, where we're going to be looking at the foreign exchange markets, we're going to be looking at the commodity markets. We're basically simply going to be looking at markets that everybody across the globe can trade. STP stands for straight through processing, Johan, straight through processing. So it is important in particular to point out to everybody who is joining us from the US today that we will be covering every single thing which you are indeed able to trade. So we need to speak about what exactly short selling is to begin with. Okay, or to go through even these frequently used terms to begin with. All right, so you have a long which is speculating that the price will rise. That's fine. You've probably heard the phrase before. We're going long the market. It means you're buying the market. It means you're speculating that the price will increase. You can also take a trade on the opposite way. So you can sell the market. And you can sell the market if you feel that the price will fall. That's also known as shorting the market. We have bulls and we have bears. And that's really an overall sentiment more than anything else. You're considered to be bullish if you believe that the market is going to rise. You're considered to be bearish if you believe that the market is going to fall. That's all that is. It's related to market sentiment more than anything else. And if you ever do flick onto any financial TV channel or even read any financial newspaper or whatever the case may be, you'll see those phrases that the market is bullish or that the market is bearish. It's bullish if it's feeling that it's like it's rising. It's bearish if it's feeling that it's falling. The reason or where those terms come from is that for anybody who knows anything, or if you've ever seen a bull in action, I'm sure that many of us have seen it in the live scenario, but we all know how they attack, that they bend down their heads and they attack from below to above. They drive upwards, so it's a rising market. And again, most of us are, if not everybody, is lucky enough not to have been attacked by a bear, but I'm sure we've seen it in some form on TV over the years where we know a bear will stand up on its hind legs and push downwards. So that is where your bearish market, your falling market comes from. All of the force is coming from above to below. So a person can be said to be a bull if they have that optimistic outlook. They can be called a bullish individual. A bearish individual would be that pessimistic outlook. You don't have to be one or the other. You can indeed be both. So you can be bullish today and bearish tomorrow. You can be bearish today and bullish tomorrow. It is interchangeable and it is dependent upon what you feel is happening in the market at this particular point in time. We will be going through in detail these longs and shorts and bulls and bears over the next lesson in particular. There are a couple of people already, Connor and John, I can see typing in. What does an instrument mean? An instrument is just a market. It's any market. An instrument is gold. An instrument is oil. An instrument is the Dow Jones. An instrument is the Euro USD. An instrument is just any market. So we talk about markets, we talk about instruments. They're interchangeable. Okay? So you can find opportunities wherever they may come from in any market. So the question which we have for you is as follows. What do you feel moves the prices in the financial markets? What do you think moves prices in the financial markets? This one always catches people out. What do you think moves the prices in the financial markets? Let's all type in. Let's see what the consensus is. Humans, okay. I like that one. I haven't heard that one in a while. Very good. There's a huge amount of people who are typing in news items, the media. News items, they do move the markets. That's fine. With people typing in speculation, Manish, absolutely. Political affairs and all of these other things. Very rich traders. Very good. But you know what? There are only two things which move the price in the financial markets. Nothing more and nothing less. And that is supply and demand. And what happens there is every single thing else which we cover is a subset of supply and demand. Greed, you want more of something. A lack of greed, you want less of something. War, you want more of something. Okay? Economic fallout, Nitin, you don't have the money for something. Everything boils back to supply and demand. Where they meet is called equilibrium. And this is only ever achieved in theory, because as soon as supply and demand meet, what happens then is something changes, Mike. The world changes. And from there, we have to have new areas in the market. We say to ourselves that in times of scarcity, prices typically rise, as does over-demand push prices up. We say when there's too much of something, the price will go down. When there is too little demand, the price will also decrease. But you see, even though supply and demand is the major aspect of the financial markets, would it surprise you if we told you that that's not how we make our profits? Okay? We're traders at the Academy of Financial Trading. Okay? I've traded for, at this stage, God, it must be going into 10 or 11 years at this stage, and profitably so as well. But I don't use it. We don't use it. And why don't we? Let's speak about it. We don't use it because it would just drive us crazy. We don't use it because it's too tough. Now, we're not the type of people who move away from things just because they're tough, but we're the type of people who say that it's so tough, it is impossible. Because there are too many variables which will affect supply and demand. And there will absolutely be people sitting there who are saying that this is nonsense, that this is wrong. It is honestly not wrong, and let's show you exactly why. Let's say that you and we, imagine we just want to trade crude oil. Can everybody type in to the second decimal place how many milliliters of crude oil you will use, let's say this coming Friday. What's this coming Friday? The 8th. Is this the 8th of January? And include all motor vehicles, all transport, all manufacturing, all heating, all plastic bottles that you consume that would have taken crude oil to make. Just type it in what you feel it will be. It's only a few days away. What do we think? 50,000 litres would be a little bit high. Well, let's stick with milliliters if we can, with people talking in about 50 litres, 60 litres, 100 litres. Okay, so let's just maybe take it that people don't really know. How about that? And imagine that you as the end user, you don't know how much you will demand this coming Friday. So how on earth could I, sitting here, have any idea as to how much you want? I don't have a large crystal ball. I don't have a cape. I don't go through any strange rituals. I cannot know the answer. Absolutely, Omar, it's impossible to tell. So why don't we just give up in trying? Why don't we just maybe say, well, how much did you consume today? How much did you consume yesterday? Maybe how much did you consume over the last 10 days, and let's average it out and have an informed opinion. So that's what we do. We don't try to predict the future. We just ask ourselves what has happened and we make a decision. And there are people out there who will look at balance sheets of companies. They will be happy to invest based on the information which is 1 year or 2 years old. They will forget that a bank, even like Bear Stearns, from an economic perspective, when analysed back in 2008, it was absolutely fine. A lot of people were investing within it. Okay? But then what happened with Bear Stearns was it just bit the dust. It was worthless in the space of a few days. So what we do is we measure the market. We invest in entities which we are interested in. We protect our profits and we work with the markets. It reduces this subjective biases. So what that means is it just reduces our own opinion, or our own reliance upon our opinion. Philip, price action is simply the movement of price. The movement of price. So we don't rely upon our opinion, we do rely on the price, and that is where we get our opportunities from. Okay? Now, we're not saying that there aren't economists who are good at what they're doing. We're just saying that it would be impossible for us to teach you those methods. Firstly, because I guess we believe in online education. We believe in teaching people from all over the world without you all having to come and park and stay here for a couple of days while we rabbit on. It's just that we don't feel it would be possible. But more importantly than that, it's not how we approach it. So we like the idea of accepting that the price reflects everything got to do with supply and demand. We apply techniques to find opportunities. We reduce the random nature of decision making. So I hope that has put into context many of the future lessons about what our approach will be. Now, this evening I am watching the clock. What are we coming up to? Maybe 8 minutes or so to the hour. I appreciate that we're probably going to run over this evening by maybe 5 minutes or so this evening. I do apologize in advance. We'll be about 5 minutes over before we start into questions and answers. Apologies, guys. Sometimes on these live webinars it can be a little difficult to stick to the exact times, but we'll do our best to come in as close as we can to the top of the hour. What I want to go through, I'll go through it quite quickly because we will be covering it at this very start of the next lesson in 2 days' time. But I just want to run through the 4 main asset classes and what they mean to us as trading instruments, as trading markets. So when you speak about currencies, let's look at currencies first. They're hugely popular for financial traders. And if we were being maybe a little bit silly, we would say it's because currency-based brokers have massive budgets. That's one of the reasons why they're so popular. These brokers can make very nice ad campaigns. But outside of that, what Forex trading, why it appeals to people is because you can use currencies as a safe haven. If you were concerned about the region in which you reside, you could put your money, your assets, into a different currency. You might look for a return on investment. You might look at the euro, where the interest rates are very low, the same as the States. Even with the previous rise in rates in the States, they're still incredibly low, where people are getting a negligible return. So you might be putting your money into a different region. You might also feel that one currency is stronger than another. What we do is we trade what we see. We don't know what is going to happen next. We measure the movement, we look for the opportunity, and we trade accordingly. The why is the causal factor. It's the historical reason as to why something happened. But the what, the very effect itself, is what's fundamentally crucial. And this asset class, Rachel, is just called foreign exchange or Forex or currencies or anything along those lines. But we just trade what we see and we leave other people to ask why. And that's crucial because, as we mentioned earlier, about our own backgrounds within the industry, it was really fascinating because too many people, too often, they spend too much time looking for the reason why. And the reason why never, ever, ever matters. And it takes people a long time maybe to reach that realization. If you see a move and if you go to figure out the reason why that move has occurred before you take advantage of it, by the time you figure out what the reason is, the movement is over. It's as simple as that. The movement is done. You've missed it. So it's better to be able to analyze a market from a technical perspective, understand what the price is doing, and then simply take advantage of a movement when it occurs. That's what we will be doing as we progress. A currency chart is something as simple as this. This particular chart is the Euro US dollar chart. It's a current example. It's a current price where the dollar is trading at 1.08493, which you can see right over on that right hand side. We have the euro along the bottom. The euro remains constant at €1, and it is the US dollar which goes up or down in value. That's how you read this particular chart. It tends to be how you read pretty much any chart. But this particular Euro US dollar chart, the euro remains constant at 1, and what changes is how many dollars you get for €1. That's all that it is, nothing more, nothing less. And as I've said already, over the course of this foundation trading program, we'll be looking at this price, this fluctuation up and down. We'll be understanding how to read it, and we'll then be understanding how to take advantage of these movements. We like the currency markets because they're liquid, which simply means they are popular, they are developed, they are mature. A lot of people trade them, so it's very easy to enter into a trade. It's very easy to get out of a trade. Information is widely available, and as always, traders will always have their own opinion as to what is actually happening in the markets, none of which will really ever matter, except those opinions are used to take positions which will move the market. What we will be looking for is to take advantage of those movements as they occur. That's what we like. Now we'll have a look at the energy side of commodities. When we talk about energies, we're looking at the likes of crude oil, the likes of natural gas. And for a variety of reasons, these items fluctuate and are very, very volatile. They move quite a lot. And they move because of reasons, I guess, outside of the scope of this webinar. Unfortunately, these items are often produced in areas of political or social instability. And that impacts our ability to acquire these items, and we see massive fluctuations in price. And we also see the global economic outlook. You can see a list of these items, and it can be important to be able to access this full range of markets. Another side of the commodity sector are precious metals. Now, precious metals are typically seen as just a safe haven. They're where people go to when they get scared of the markets. And do you think when you get scared, you behave rationally? What do you think? When you're scared, are you rational? And I know some people might type in yes, but generally speaking, it's safe to say that when one is in fear, one is irrational. Normally speaking, okay? Normally speaking, one is totally irrational. Now, if you've got a market which is purely related to human emotion, do you think that market will be volatile, or do you think it will be calm? If it's fundamentally related to how humans feel about the world, what do you feel? Absolutely, it's extremely volatile, and that results in opportunities because a fluctuation means that there is opportunity, that there is a swing in the market. If a market is not moving, then you can never hope to take advantage of any opportunity because it just isn't providing any. But when a market is moving, that's when risk is involved, and where there is risk, there is also reward. So we like anything which moves. We like anything which can generate a profit when handled correctly. The next side of commodities are the soft commodities. These are items which are grown as opposed to mined. And these offer great opportunities because, as we saw earlier, you can have pest infestations, you can have weather-related matters. So we like finding opportunities in these particular areas. Very, very similar to the precious metals, except, as I've said, they're grown, they're not mined. So that's what the definition of a soft commodity is. It's grown, it's not mined. Okay, so we like these again because they're volatile. The next class, the next asset class that we want to look at are stocks and market indices. And these allow us to access financial markets. During this course, we're going to be covering a very diverse range of markets. We're going to be covering all of the areas which we've been discussing up to now, and we'll be discussing equities and these market indices. We'll be talking about equities and how they're designed to raise operating capital. We'll be talking about speculators who come in to make this market viable. And then we also have market indices. What we mean by a market index, indices, is just the plural of index. I think we all know a good example of an index is, as you can see at the bottom of the screen, the S&P 500 in the US, or the Dow Jones in the US, the FTSE 100 in the UK, or the ASX 200 in Australia, or the Nikkei 225 in Japan, or the DAX in Germany, or the CAC in France, or the, what have we got, the Hang Seng in Hong Kong. So these are the index, again the plural being indices, and they are our composites of these equity markets. You've got these situations where you could trade baskets of objects. Absolutely, the OMX 30 in Sweden, very, very good. So you could trade, for example, the likes of that S&P 500. So the top 500 American listed companies. And that's a nice way to access a market if you couldn't otherwise access it. Because if the top 500 markets in a particular region are not performing, well, I guess top 500 objects or companies, well then obviously there are issues in terms of the entire economy. Now what we want to look at are bonds. We will be looking at bonds because a lot of people take advantage of the bond market. Not only the corporate bond market, but also different countries' bonds and how they sell these bonds and how we can then trade these bond markets. So, governments, what they simply do, a very brief, a very small or simple explanation on bonds. They're simply, I guess, IOUs that governments put out in order to fund the day-to-day activities of specific countries. Where there is greater risk associated with a particular country, they would have to pay quite a high interest rate to anybody who was willing to invest in these bonds just so they could actually generate interest. So they would have to give you quite a high return. If there was a relatively stable country, a relatively confident country, if you like Germany, they would not have to give such a high return because it seemed to be, again, quite a safe haven. It seemed to have its house in order. The unemployment is relatively low. Employment is relatively high. They have a lot of manufacturing. It's the engine room of Europe. So there is a lot of confidence in Germany as a whole. So that does not have to provide a massively high return for anybody who is willing to provide it with funding, basically. If you're looking then at the flip side, looking at somewhere like Greece. Greece would not have a fantastic name as a country which is very stable. It obviously has very high unemployment, very low employment, very little manufacturing. So in order for Greece to receive any funding from the market, it would have to pay quite a high return, quite a high interest rate. But we will again come back to these specific classes as soon as the very, very start of lesson number 2 in 2 days' time. We'll look at them in a bit more detail to understand how they work. So you've got so many choices. What should we look at? We know that there are people out there who will tell you to trade one market. We know that there are people out there who will allow you to trade for free. Because obviously they're a charitable organization and they just want that warm, fuzzy feeling. So what we prefer is to say that if you spread your risk around, you are less likely to encounter major headwinds. So that's what we try to do. We try to reduce the swing in our account from day to day. We must also talk about who makes up the markets. The large financial institutions, they manage risk very well. That's the lesson we'll take from them. Multinationals, they focus on hedging. We will cover that much further as we progress. Then we've got speculators, you and I. What we do is we take risk in return for reward, in return for pursuing that larger upswing. Now, all of these 3 categories, they fundamentally interact. And we ask ourselves, how do most people trade? They trade looking at fundamentals, they trade looking at technicals, but most importantly, they tend to trade badly. What we are going to help you do from the next lesson onwards is to not trade badly. We're going to look at counter retail trading techniques. We're going to look at how a market maker does their business. This is important. So we're now coming towards the end of this evening's lesson. I have one final question for you. It might seem like a funny question, like a bit of an unusual question, so early into a foundation trading program, but I want us all to look at a chart, and I want us all to make a decision as to what we feel that chart is going to do next. The chart which we are going to look at is crude oil, is WTI. And while you're looking at this, I want you to make a decision. What will it do from here? Will it go up? Will it go down? Would you go long? Would you expect the price to rise? Would you go short? Would you expect the price to fall? Or do you think it's going to do something else? And while you're typing in that, I know somebody had asked the question earlier about Brent oil or WTI. There are two different oils that you can trade. WTI is the American oil. Brent is North Sea oil. So that's what it is. So WTI is West Texas WTI. And Brent is just North Sea oil. So that's the difference between the two. But what we will be looking at, again, great to see so many people typing in. Fantastic, great stuff. But I guess, you know what? While you're typing in, let's have a look at something. The market was indeed moving sideways. I saw that somebody else had asked, how can a market move sideways? We can see that it was moving sideways throughout September into October of last year. We can then see that it moved downwards quite substantially, but in a very organized fashion. It moved downwards from November right through into mid-December. And most recently, we could say that maybe it's staging a little bit of a comeback. A little bit of a comeback. So it's beginning to rise again ever so much. So Odd, you can type in right there, right in that chat box where you typed in your question. That's where you also type in your answer. That's where I want to see it. So we'll be looking at this type of technical analysis as we progress. We'll be showing you how to read charts just like this, and we'll be then showing you how to take advantage of these types of movements. So I would hope that maybe a lot of people might have found this initial class a little bit boring. Hopefully not. Hopefully we went through things which were of interest. Hopefully we're looking at things maybe a little bit differently than what you have been looking at them for up to now. We will be giving you access to these charts as well, Marcus, as we progress. That's fine. And anybody else who is asking about where do we get access to these charts, we will be providing you with a trading platform. Hey.